Metamaterial stock has been trending in popularity recently, and many people are wondering if they should be buying more, selling what they have, or standing on the side to wait for a better timing. As the market is still very volatile at the moment, we should always be mindful about which stocks to pick and what would be the exposure and timing of our positions. Over the past few weeks, the price action of MMAT has brought the stock to $1.58 before stabilizing around $1.44. The short-term trend of metamaterials has been ranging and testing the bottom that formed around $1.40 over the past few months, and so far that line has held its ground. The stock is showing some very interesting price levels as we speak, and there are lots of reasons to believe that the volatility will be picking up again and that the stock's downside is far less than the upside. The long-term trend of metamaterials has been ranging between a floor around the penny stock level in general, or where we are now, and a ceiling around $10. What this suggests is that metamaterials is a relatively high-risk and speculative stock, whose main attraction is also to benefit from rapid capital gains, if we are patient enough. Now, let's also take a look at the technicals of the stock. The trading volume of metamaterials has recently been 1 million shares versus an average volume of 4 million shares. Over the previous 52-week period, its price fluctuated between $1.38 and $21.76. The market cap of metamaterials is currently at $407 million versus the enterprise value of $530 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient as well. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that a company is able to generate more profit or to have more growth than another company, partially because it may have a better management team, a stronger brand recognition, a bigger online following, and more. It is basically what is unique about this company in particular compared to an alternative competitor. In other words, it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, especially in very volatile situations. If the company goes to liquidation, the goodwill would be gone, and we would be left with potentially less assets to distribute to shareholders and debt holders than the number on the balance sheet. When we compare the current price to the historical price fluctuations, the stock is 4% higher than the 1-month low, 5% higher than the 12-week low, and 5% higher than the 52-week low. On the options market, which gives us a hint on the market sentiment on where the stock price is likely going to go next, the implied volatility is 143% versus a historical volatility of 97%. The put-call volume ratio is currently at 0.03. It is normal for many stocks to have a higher put option volume than what they deserve, as many buyers systematically hedge their positions by buying put options. The most recent volume of options traded is 2,000 contracts a day versus the 30-day average of 4,000. In terms of open interest, the most recent volume of open interest is 54,000 contracts versus a 30-day average of 94,000. In terms of shareholder structure, institutional shareholders own about 26% of the outstanding shares. The biggest shareholders include State Street, BlackRock, and Vanguard. It's relevant to understand the shareholder composition of a company, as this helps to determine if you should be holding the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this may be a sign that the stock may not have the depth to justify long-term trust. Typically, the consensus is that there should be around 25 to 30% of institutional participation for the stock to be perceived as an investment and not just a trade. This is obviously subject to a lot of exceptions, as many great companies are also mostly held by retail investors as well, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there are significant short interest in the total volume, this is a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 16% of the total float, and 72% of the transactions coming out of the dark pool. Usually, if the short interest is above 15% of the total volume, and that a significant portion of the short volume coming out are from the dark pool, it may suggest that there are significant institutional positions taken to short the stock, and there would be potentials for a short squeeze. My recommendation for the stock is to buy it and to make sure that the position is structured so that you're able to stay in the market for at least 6 months or above. I believe that the market will have its volatility picked up once again, and that the current level is considered to be the bottom of the stock, at least for the short and medium term. I would recommend to commit between 1 to 3% of your portfolio in the stock. I would also recommend to split your allocation in batches of 30% at a time, so that you have the opportunity to buy more if it retraces further. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.